Thank you for listening to Mailbox Money, your guided tour through safe, sacred, and speculative investing with a plan and a purpose to do more good with newfound peace of mind. All right, everybody, welcome back to another episode of Mailbox Money. I'm Jackson Wood, joined by my friend, my partner, Ryan Kruger. In today's episode, we are going to talk about what we call the simple portfolio. And there's a few components of a simple portfolio: safe money, sacred money, speculative money. And we are going to spend some time talking about each one of those categories. If you listened to last week's episode where we talked about our tournament of stocks, that applies directly to the sacred component, sacred section of an investment portfolio. But the reason that I wanted to bring this topic to light and talk about this today was because earlier today, I had the chance to talk to like 30 to 35 business owners, and they were asking me questions of how to kind of structure their business and how do they know when the right time to invest is. And the conversation between investing in their business and diversifying in other assets, how much cash to hold on to at the business, what to invest in when they decide they finally want to part with some of their money and invest it into companies. And this kind of became the epicenter of the conversation and walking through this. And I think whether you're an entrepreneur or you're just a investor trying to build a financial plan, I think that this will be helpful. And to clue everybody in, this is exactly what Ryan and I do in our own portfolios and for all of the people that we work for and that we're blessed to work for as their partners. This is very profound. So although it's called the simple portfolio, and I might have some exciting news regarding the simple portfolio here in like a week or so, it's very robust, and it's taken years and years of studying and planning and case studies and working with clients to come up with what we feel is the optimal portfolio for young investors and for those that are already retired and living on their portfolios.
And simple, not to be confused with quick or easy. However, anybody is capable that's listening to this right now of starting or finishing with a simple portfolio. It's not overly complex, but I would say deeply informed simplicity is the holy grail. And it took me a couple decades to get there. And the illustration that I always think about with your simple portfolio is me sitting down with a world-class chef. And I knew I was going to never be like him, especially when he wrote out on the back of my receipt the couple of ingredients to the best dish I had ever had in my life. It was so simple and so short. And fast forward, every most complex financial plans and investment balances, we believe in a holy grail of a one-page rule as well. Anybody listening to this, you should be able to collect everything you have and explain it really clearly and passionately with your elbow deep in the ingredients with your spouse or partner or the people relying on you, whether they're doing this on your own or you have a guide and a chef that you like to eat with, in our case. But he gave me the ingredients, and he knew he could do that because he knew I wouldn't come close to matching the craftsmanship and the love. And the other message there was the quality of those ingredients. Putting them together, the simple portfolio is extremely simple, but they're organic farm to table ingredients we have found. So we're removing fat middlemen and layers and friction points that Wall Street is heavily conflicted with. And we escaped Wall Street, opened our own objective, independent shop so we can share these truths. We couldn't say some of these things when we were there. Compliance department wouldn't let us share some of these simple organic truths that are hiding in plain sight, accessible for anybody. It's how do you put together with discipline and balance so you don't overly complicate them and start including artificial ingredients.
You know, that I think that is profound. And the reason that we like the simple portfolio from an investor's perspective or an allocator's perspective is that it's appropriate whether the market is like it was last year, very bumpy, very rocky. Everybody's concerned. Everybody's paying attention, getting out of stocks, just panicking. or whether the market is like it is this year in 2023, it's off to the races, that everything is looking good. Instead of that flip flop back and forth of trying to time what assets you own and where you're investing, simple portfolio is what you can use all the time. So without further ado, we're going to kind of dive into this. And the safe asset, the safe money is where we're going to start. And that's what we recommend everybody starts with. And when we're talking about safe money, we're talking about good old fashioned cash. And as I was prepping for this episode, I pulled up a chart of money market rates. And I wanted to go back to 2010 and kind of chart the yield on money markets or cash deposits. And my software wouldn't work because the rates had gone so high that the scale on the y-axis of the graph wasn't adjusting as fast as the rate was coming up. But just good old-fashioned cash, which I think is especially important for business owners and entrepreneurs to hold on to, but in your own portfolio, cash is now yielding close to 4%. Every time I drop my kids off at school, I drive to my office and I see the CD rates for the local credit union, and I've marked 3 weeks in a row, they've gone up by more than 1%. So for the first time in my career, and faster than my software could change the intervals on the y-axis, cash is now yielding something pretty generous, right? It's close to 4%. You can find CDs at 6%. Ryan and I have talked about individual bonds, whether it's treasuries or our favorite AAA rated insured municipal bonds. We're getting yield on safe money that for the first time in my career is pretty exciting. And I don't want to date myself here, but I've never seen yields this high. And whether they go down in the future or if they remain elevated, doesn't matter. But the core starting point in the simple portfolio is having a pile of safe money. And it can't be overlooked, especially in periods when the stock market is very happy and doing really well. The temptation will be to decrease your safe allocation so that you can go take more risk. But what we've seen, and especially last year, is that can be a recipe for disaster or at least for anxiety.
As beautifully boring as that sounds, that's actually where the biggest difference between most of the plans we see done wrong and our version of a simple portfolio. Before we even get to the next two, make sure that that word safe is very different than conservative or fixed income. Safe, those only couple of organic ingredients that Jackson just mentioned, cash, insured deposits, risk-free bonds held in your own name outside of a fund, not any other flavor. And there are incredible amounts of what are described as conservative bond funds or bond-like or fixed income that have all sorts of risk and fees. So one of the first questions that I ask someone that wants us to pop the hood and look and, hey, tell me what you think. How much do you think of your nest egg, no matter what the size is completely removed from harm's way? That question is more often missed than anything else we're about to talk about, which more people like to, and it's a lot more fun. Here I am in the middle of the stock market every day, and I still believe in, and a lot of folks in my business think nobody should ever own bonds, especially a professional money manager that can actively attack the market. Why in the world would you want to have something that can't go up in value by the time it matures? And that's exactly why. That discipline that it unlocks, that safety, when your head hits the pillow, I want the same thing. I want some of my money completely removed from harm's way. And there's only a couple of flavors where you could say truly risk-free, not low risk, not conservative, risk-free.
And I'm not trying to pick on 401ks or these retirement plans, but a few years ago, the 401k industry shifted from an opt-in to an opt-out structure where when you got a job with an employer, you had to opt into the 401k. Now you're automatically opted into the 401k plan, which I think is fantastic. But inside of that, they automatically will enroll you into target date retirement funds, which it's a single mutual fund that's a fund of funds, and it holds U.S. stocks, international stocks, U.S. bonds, and international bonds. And what it does is it increases your bond allocation the closer you get to your target retirement date by default. So it's a very simple mechanism. But sometimes investors who are using these low cost strategies and trying their best to plan for their eventual freedom day don't realize that they're allocating more and more money the longer they work and the older that they get into these bond funds. Last year was the worst year on record for the 60-40 portfolio. Now, if you take those exact same bonds that those funds own and you own them individually, whether it's treasuries or munis, you don't have the same risk owning them directly as you do through a fund. So we talk about that all the time. And another component of safe money when we're thinking about those that are close to retirement or getting into retirement is maximizing your Social Security strategies and a pension if you have one, or looking at the option of a private pension. Social Security is something that I find nearly all of my clients don't fully understand the timing and the strategies for when to take that on. A good example of this is a client that's an accountant, been doing tax returns, seen this for decades. He missed before he started with us, the idea that his wife, who was a homemaker her entire life, was eligible for Social Security benefits simply as a spousal benefit to him. And so taking some time to make sure you're maximizing your Social Security income strategy also helps you sleep well at night. And we consider that part of the safe money category. And if you have a pension, I'll never have a pension because they just don't offer them at employers anymore. I think it's like 6% of the workforce is offered some sort of pension. But understanding the benefits there, if there are spousal benefits, how to protect if there aren't, that's a really crucial part of understanding kind of this safe money and this cash flow. Without further ado, I want to get to the one that Ryan and I probably spend most of our time talking about, which is the sacred money. So the sacred money is kind of one step above in terms of risk. Now we're talking about stocks. We're talking about volatility. There's all types of flavors for investing and how to allocate. And we talk about dividend growth. So what we want in our sacred money category is to own, as an investor, have a stake in companies that are continually raising their dividend, so that you have a stream of income from your safe money and a growing stream of income from your sacred money. And it takes rolling up the sleeves and popping the hood to look at the market. Talk about this in our last episode, but understanding that, yes, inflation is a thing. Yes, the cost of living is going up. So we need some streams of income that are going to grow as you increase it, as you age, and as you get older, as your cost of living goes up. We can go on and on about sacred money, but this is kind of the fun part. But I want to make it clear that we don't start here. We start with the safe money and then move into the sacred money. And the reason we call it sacred, because it is extremely important that investors have rising income through retirement.
Our definition is important, and the math is important, and where we spend all of our time selecting and whittling down the market. Last week's episode is about a tournament of stocks, how we do that. All of that is sacred, but what I get most excited about and where my joy comes from is how sacred feels to an investor that may have not chosen or been able or wanting to do any of that work, whether they're relying on help or not. A sacred investment that is kicking off free cash flow, whether you're a business owner or a dividend stock investor, it's the same thing. You feel a lot differently about that business riding through good and bad times than one that's speculating or hoping that they can sell it at a greater price, with all the anxiety that goes with that and the anxiety that comes with falling prices if you're relying on getting out of something to generate money to eat on at some point in life. So when you go through a period that was described as a awful, historically awful in some cases, 2022 bear market, and if every single one of your businesses gave you a pay raise year over year that you can hold in your hand to know what is real, then if somebody gives you a lowball offer to take the whole business away from you, you will laugh at them, because what you are holding is sacred to you. And it's not an opinion, it's not a feeling, although it generates one. It's real math that you can hold in your hand. That's what we mean when we say sacred. There's math to it. There's also the embedded discipline and the emotional aspect of the market. Looks a lot different. It feels a lot different if you're holding it sacred to you. Doesn't mean it's without question. I mean, we believe in sell those funds and actively managing it, but the math of generating those dividends creates a whole different outlook, and you hear the distractions of the market and bad news very differently. You can just ask your business. You can go ask them, are we giving pay raises this year or not? If they are, and it's coming from high quality sources, then you have to ask everybody else around you, what are you worried about? They don't have that sacred holding. They have something else. They're speculating with too much first.
Yeah, that's right. And to me, that just can't be emphasized enough, that the math does back this up, but what we're looking for is a requirement that income is continually growing. Had a conversation yesterday with one of my clients where they had $50,000 of extra money in their bank, and they were asking me, hey, should I invest this in kind of my sacred sleeve and put this in the market, or should I keep this in my bank account? And to be honest, the math, the numbers would have given them either answer, I think would have been okay if they have plenty of cash reserves and they've got their safe money built up. But I dove into the conversation and I said, if you take that money and you invest it and there's some volatility, is that going to make you worried? And are you going to be spending this money soon and you want to be able to pull it back without the chance that it's gone through a down year? And for the first time in my career, I felt like they're doing an incredibly good thing by keeping this in the bank at a 4.5% yield, and it's building up their safe money. But what it did was it made sure that none of the money that they have invested was scared money. They're not going to be panicking or worrying that if the market goes down, they made the wrong call by playing the conservative card and keeping that at the bank. And that, to me, is an important component here of finding that right balance. And that's another thing that we require for the sacred money and any money that you invest, is that none of it is scared money, because the market does go through swings and the market can go down. But if you're a stakeholder and you're getting pay raises, knowing that, and you're not putting additional money at risk to feel uncomfortable, to me, that's a really important component of finding this balance between the safe and the sacred allocations. Now, I've got something I heard on a podcast that I kind of want to relay into investing. And I think that this is timely because in the current economy, we're still seeing weird dislocations with used car prices being more expensive than a new car. So I was listening to kind of the history of this, and they talked about just-in-time manufacturing. And I hadn't thought about just-in-time manufacturing since I did my MBA in college, and I had to write papers on this. Forgot it as soon as I left school. But the idea is that in the 1970s, this concept of just-in-time manufacturing started in Japan, and it took over the automakers in Japan. And what these manufacturers had to do was, instead of keeping these massive amounts of inventory on hand and fulfilling orders as they came into the business, they were able to, because supply chains were so efficient, get the inventory right in time for them to build it and send it out. And so it started in Japan, and it took over all of these different industries. And it worked great. The companies that did not implement just-in-time manufacturing had these parts of their balance sheet that were unproductive, and the other companies could invest in growth and acquisitions because they didn't have to have tons of money sitting on the sidelines tied up in inventory. And then with COVID and the global shutdown, all of the just-in-time manufacturing hit a wall. And the companies that hadn't adopted to this and still had these large inventory builds were able to quickly take market share and gain against their competitors who were now struggling to get everything in to build it and ship it out. And my brain automatically tied this to the markets, where if you have your safe money and you have enough money there, and all of a sudden the world hits a speed bump or the markets get shaky, you're not trying to reallocate in and out of different positions and take advantage of things going on sale and buying at discounts. You're perfectly balanced, and you can survive any, kind of any transition. And it reminded me of a saying where in a bad market, you need a 60-year-old money manager. And in a good market or a bull market, you need a 20-year-old money manager. And just this idea of flip-flopping, you're going to get whiplash, first of all, and you're going to get the timing wrong going back and forth. And so if you have this safe money or this inventory of cash and insured deposits, it ensures that none of your sacred money is overexposed or turns into scared money, and you can sleep well at night knowing that you're in the perfect allocation.
As they say, when the tide goes out, we find out who's got swimsuits on and who doesn't. And the economy and industries and myths like just in time are no different. COVID didn't cause some of these problems, they revealed them. I thought it was a little odd that people kept expecting cheaper and cheaper things to be delivered faster and faster and faster without any question about quality, and demanding more, expecting more, and dare I say, appreciating less. And so when we shared our picture book this last week and how all of the markets look to us, and anybody listening to this is happy to subscribe. We like to share it all. The way the markets look to us, we called it a return to real reality. And inside of that, one of those is a complete dispelling of a myth of just in time is better across the board and offshoring everything for cheaper, faster. I would say trust in time is far long lasting than just in time. And there is something to be said about craftsmanship and quality. And be careful what you ask for, America. You don't want to pay less for everything. That chef that I sat down with, I only got to that table and the ingredients are staring at me. It's still hanging on my wall after I was declined a seat at the first dinner. I wasn't in time. And they said, if you want to reserve early for tomorrow, you can. I wanted it even more then. Hint, hint, small business owners. It's not all cheaper, faster, just in time. Trust in time that when I did come back, he said, oh, by the way, we only make 40 of these dishes you're after per night because we do it with such handcrafted care. My mouth was watering at that point before I'd even sat down, so that I got to sit down and go over the ingredients afterward. Trust in time is worth it, and investments should be no different. So a lot of these crises and recessions, they don't cause the problems. They reveal problems that our expectations were unrealistic or we had too much leverage on. The ingredients never change.
I love that. And one of the things that I want to kind of implement or emphasize is once you've got your safe money and your sacred money, and you know what income you'll have in the future, and you know that you have enough stability in the safe money category, there's the idea to speculate and to buy investments that possibly are not producing cash flow and to look for growth opportunities. When we talk about speculative money, we're talking about growth investing, crypto investing, that's investing in cryptocurrencies, which we believe in, and we think that they have some potential in the future, venture capital or private investments. What I want to talk about with speculative money is that these assets go through what I call risk on and risk off. And I took that from the industry, but they do very poorly when it's a risk off environment. When you can go buy a municipal bond with a tax equivalent yield of 6% versus, some crypto investment, money is going to flow out of crypto and into these more safe categories. But if you have this balance throughout your portfolio, when everybody is running the other direction, now you can start looking at these uncrowded ideas. And in fact, last year, crypto was down as a market cap of all crypto, like 60%, which is pretty wild swing. And most people were panicking and selling at the lows, but those that had safe money, sacred money, speculative money were able to inch their way in and take advantage of this uncrowded idea. And just happens to be that this year, crypto market cap is up close to 50%. And we're only like a month into the year, month and a couple of days. So speculative money is investments that if there is a surprise, it will be to the upside. If the strategy doesn't work, it will not derail the rest of the portfolio. You're not betting your fortune or your future on one single trade or idea or innovation or disruption. You're taking a small portion of your portfolio and allocating it here, knowing that there is some potential big upside. But if that doesn't come to fruition, it's not going to jeopardize the rest of the portfolio and the rest of the financial plan. This is the exciting part of investing. This is what you will see people talk about, what they write articles on, and what the news and reporters will talk about. But we believe it represents a small portion of the portfolio for those people that can check the box on the safe and the sacred money.
And so how much? And this is the question that the smartest professionals out there wrestle with. How much should be in the speculative How much is risk? How much is aggressive? It's my least favorite of all questions that advisors ask potential investors. Your feelings on conservative versus risk, thresholds, and all of these different ways they score it. And I always think about how quickly I would run, not walk, from sitting down with a doctor if he ever asked me what kind of shot I felt like taking that day. Brother, I want to hear the odds of success based on every bit of the best research in the world. Tell me what you would do. So the way we would answer that question that simply applies to anybody listening to this is, once you have some money completely removed from harm's way, safe money, and you are adding to sacred money that can pay you while you sleep and rising streams of income, when those two, safe and sacred, are able to eventually, not now for everybody that may just be starting, when they can eventually answer the question of providing enough safe and rising income streams to cover all your needs and wants, to do something better than retire, we call it Freedom Day, then whatever is left, it could be 7%, it could be 50%. You could completely put all of it in harm's way, at risk, in the speculative sleeve. And by the way, the reality here is some people that may be zero for a while. First things first, broccoli before chocolate cake, as I always say. I get a little more aggressive pushback on that now that my little kids are also teenagers and they think they can outmuscle me to the chocolate cake, but we're going to do first things first. And it allows anybody the ability to have the most sophisticated, balanced portfolio without having to constantly wonder how to optimize it and read all of these articles about what percentage to have. You can answer it, and it's a different answer for everybody. After you have safe and sacred, whatever is left over that you're not relying on to live, it can all be in harm's way, because, by the way, the definition of that, it could all go to zero and it wouldn't change your life. And now all of a sudden, you have just given yourself, with a simple portfolio, in our opinion, the most unfair advantage of any investor in looking at all of these markets. No scared money.
I love it. Hope everybody enjoyed the simple portfolio. We are more than happy to help anybody, answer any other questions that you might have. You can reach us at team@freedomdaysolutions.com. You can visit our website, freedomdaysolutions.com. And with that, we will see everybody next week.
This show is brought to you by Freedom Day Solutions, LLC, a registered investment advisory firm advising individuals and families nationwide. Performance is not guaranteed, and past results are not necessarily indicative of future performance. To learn more, visit freedomdaysolutions.com. This show contains general information that is not suitable for everyone and was shared for informational purposes only. Any forward-looking statement or opinion expressed is subject to change without notice. Nothing contained herein constitutes investment, legal, tax, or other advice, nor is it to be relied on in making investment or other decisions. Clients of Freedom Day Solutions may hold positions in the securities discussed.